One of the key things that people skip over when they're buying their first investment property is not defining or thinking about their investment goals. Having a property give you $100 a week or 5 grand a year is not going to change your world at the moment. But over time, as the rents increase, as the values increase and rents keep growing, as your loan starts to get repaid, the property becomes more and more cash flow positive.
Welcome to Perth Property Insider, where you will learn how to grow your wealth and improve your life using Perth property. Our show is brought to you by Investors Edge Real Estate, the highly rated and award-winning property management, sales and buyers agency servicing the whole of Perth. Now, here's your host, Jared Mann.
G'day and welcome to another episode of Perth Property Insider. I'm your host, Jared Mann, and today I'm bringing you my first time investor's guide to property investment. Why? Because I've seen a lot of first-time investors posting questions in our Perth Property Investment Facebook group. So if you're not already a member, head on over there. And it's always great to see our other members that are a bit more seasoned and experienced helping the first-timers out. No question is a silly one, unless it is. But no, everyone's got to start somewhere. And I thought this would be a really good episode to guide people on how to avoid a lot of those mistakes that you can make, especially in the beginning, because if you make a mistake on your first property, it can prevent you from being able to do anything else for a really long time. And it could turn you off property investing altogether, which would be such a shame. And I was thinking back to 20 years ago when I first started and bought my first property. We actually forget all the things that we've learned along the way. And I start to almost take the basics for granted when I see some of these questions getting asked. So I wanted to help by filling in some of the gaps. And if you are a more experienced investor, there's always more to learn. And I'm going to put some more advanced sort of things sprinkled in here to hopefully give you some takeaways as well. So it's definitely worth trying to get your first property investment right, because that can help you leapfrog into building the rest of your portfolio. And that was certainly the case for me. My first investment deal I really hold fondly still. It catapulted me into being able to get that second, the third property. And before you know it, you're building a portfolio. So let's set a bit of the foundation, shall we? One of the key things that people skip over when they're buying their first investment property is not defining or thinking about their investment goals. So when we invest in property, we don't do it for a tax saving or for negative gearing. The primary reasons we do it is to get capital growth first and foremost. So to grow an asset base, grow your equity in that property. That's going to give you choices down the track to bring that back around to put towards a home if you want to either purchase your first home later or upgrade your home that you buy. It's also going to give you choices when you head closer to retirement. And, many people use the money that they create from their properties to start a business and do other things, like much was the case with me. The other reason that we invest is for cash flow. Now, early on, people sort of, I think, focus too much on trying to create a cash flow. The ultimate goal is for our properties to supplement our income and or replace our income so we don't have to work in a job and we've got the choice. But I would think about how important the passive income side is, because there's always that trade-off between, if you buy a more premium property, you're going to likely get a higher than average growth rate on the property and a lower rental yield. So that makes it harder to hold the property. And if you buy a lower end property, which is typically going to be the case because you probably can't afford too much when you're starting out in any case. So that's going to be a lot more higher rental yield, and it's going to have a lower ongoing sort of average growth. Now, that's not to say that in this stage of the market, with Perth still going ahead strongly, that you can't buy a lower end property, take an apartment villa or, townhouse, or you can be selective in the lower end when it comes to houses still, and experience above average growth for the shorter term. But what I'm alluding to here is longer term, a lower end price property is generally not going to perform as well for capital growth as a higher price property. So I usually say to people, get into the highest price property that you can comfortably afford, and ideally set your sights on holding it for at least 10 years, because when you try to hold it for 2 or 3 years and get out, that brings a lot of risk into things. You're bringing transaction costs into things. Ideally, you want to hold it with the view that this is going to be a 10-year purchase and look at it that seriously to make sure it stacks up for that as well. And what I was alluding to with cash flow is that, having a property give you $100 a week or 5 grand a year is not going to change your world at the moment. But over time, as the rents increase, as the values increase, and rents keep growing, as your loan starts to get repaid, the property becomes more and more cash flow positive. It's going to start out, in all likelihood, every purchase in Perth that you're going to make at the moment, if you buy it with a loan on it, with 80% or 90% loan, it's going to be what we call negatively geared. So the property is going to cost you more than the income that you're getting on the property, and that's normal. So we have our rental income. We want that to be stable and from a good tenant. We have our expenses. So the kinds of things that you need to think of and factor in is your loan interest, obviously. Then you got your council rates, your water rates. Council rates is usually 2,000. Water rates is usually sort of 1,200 to 1,400 on a typical house. Check it out for whatever specific properties you're looking at. If you're buying into a strata property, check out what the strata fees are. Check out there's no special levies coming up that could scare you or really eat into that give you a much higher fee to pay. What other costs have we got? We got insurance to pay. It's best to have building insurance, have landlord's protection insurance, and they're the sort of two key ones to have as far as insurance goes. And then you're going to have your ongoing maintenance costs. So on a typical property, I like to allow at least 5 grand a year. On a sort of character older property, you're probably going to be up for 10 grand. Some of my properties that are like that are costing me about 15 grand a year. There's just always something needing to be fixed on them. So you just want to make sure that you're aware of these expenses. And usually these expenses exceed the revenue or the rent that you're getting on the property. So that's when people throw around the words negatively geared. It means that the property's costing you more than it's making you. And that negative amount can then be offset against your tax by basically reducing your taxable income. So let's say your loss is 10 grand for the year, just to call it even numbers. Let's say your taxable income is normally 100 grand. So your taxable income would be reduced by that loss of 10 grand. And that means you're not paying tax on the 10 grand. Let's say your tax rate, I'm not sure what the tax rate is at 100 grand, but let's say it's 22 cents in the dollar or something. That means you're really only saving, out of the 10 grand that you're losing, you get 2,200 back in your tax at 22 cents in the dollar. So negative gearing helps you to afford holding the property, but it's certainly not a reason to go out and buy an investment property, because you're still losing money between the rent and the expenses. And why would you ever do that? Well, property in Australia is a much more of a capital focused sort of asset. You're doing it really for the capital growth that you're going to receive. And that's the main goal, I think. That's going to give you a lot more choices. And then you want the sort of cash flow later in your journey once you've built that capital base. That said, you don't want your properties to be costing you too much that's not affordable. And you want to be able to hold them longer term and make that sustainable. So when we look at what sort of goals you have for the property, think in your time frame, think on what are you hoping for capital growth wise over the next 1, 2, 3 years, and think of, what are you expecting as far as cash flow wise. And I like to start with what amount am I able to save that I can put towards my investing. So if you know that you can't afford any more than a 15 grand, you can save 15 grand, put it towards your investing each year. That's really going to inform later what you're going to be choosing as a property, how you're going to be, what sort of price point you're going to be looking at, and then what sort of over cash flow that you can afford on that property. So defining your investment goals, step 1. I went down a bit of a rabbit hole there. I hope you're still with me and I haven't lost you. Step 2, let's understand your budget and financing options. So I'd suggest that you get a good finance broker here who can help you run the numbers. They have some excellent calculators where they can punch out, start with assessing your situation and work out what your overall borrowing capacity is. So that's usually the maximum amount that you could borrow. You then want to look through to, based on typical rental amounts for that sort of borrowing amount, the broker should know and be able to punch in, some typical rental amounts. You can go and confirm those later, but let's say if you're looking at a 500 sort of K purchase, I'd sort of expect probably a 5.5 to 6% rental amount. If you're looking at a sort of 6 to 700, you're probably more at a 5% rental yield. And then if you're going upwards from there, an 800 to sort of mil purchase, you might be looking at a 4 to 4.5% rental yield. And I won't go much higher in the prices because most first timers aren't going to be spending over a mil. So borrowing capacity is one thing. What you can afford is another thing. And you need to make sure that you're not going to be having too many sleepless nights and you can still have a life around it and that you can still save money and be able to take holidays. By all means, you might need to do some hard yards initially to get your foot on the ladder of the property market. I certainly remember feeling that things were pretty tight. It's amazing how much you can do with $100 a week when you really stretch it, and it forces you to learn, how to find more value in things and be more frugal and stretch your dollars further. So I fully get that it's really hard at the moment with the cost of living the way that it is, and look at sort of more creative ways. So can you stay at home for longer while you start out with your investing? And that's what I did. Had bought my 3 or 4 first properties before I looked to move out and just kept my overall expenses low. Now, let's continue to look at understanding your budget and financing options. So we typically look as an investor to have our loan as interest only. And you'd be surprised how many investors I still come across that have their loans set up as principal and interest. It's all well and good to have a principal and interest loan where you're repaying the principal over time, but I'd initially be keeping your loans interest only, giving your properties a chance to increase in rents and become more neutrally geared. Neutrally geared's where property wouldn't be costing you anything. It'd be neutral on its expenses to income that you're getting on it. And then you can switch the property to principal and interest and take what you were otherwise sort of paying towards your loan interest and pay that towards the principal instead. It really does add up to a much higher amounts that you need to pay, much higher cash flow. And I'd rather be seeing you park that money in your offset account, save it towards your next property, or save it as a buffer initially to make sure that you've got your rainy day fund, and rather than being forced to pay it off of the principal. So the typical term that you can get an interest-only loan for is usually between 3 and 5 years. I always try to get 5 years as longer term as possible so I don't have to refinance, and I've got that flexibility. And it is important once you zone in on, a budget, an amount that you're happy to buy. I'd sort of cross-check it with what you can get in the market, make sure you're happy with that. I'll go into doing your research in a minute. But I'd suggest getting a pre-approval or a letter of eligibility from your finance broker so that when you do start making offers, you can show that pre-approval to the selling agent and show that you've got your finance together and ready to go, because it's going to be competitive at the moment. You're probably going to be up against multiple other offers, and you really need to have your ducks in a row and have your finance sorted before you go looking at things. So final one that might help with your financing is to see if your parents could perhaps guarantor your loan, or, if they're really generous, gift you a deposit. So what I ended up doing to begin with is something in between this. So my parents and I joint ventured and went 50-50 in our purchases. Some of the loans went in my parents' name, with me still being off the title and off the loan, but it was understood that we were sharing any upside by 50%. Other loans went in my name, and they, in each case, initially provided their equity to use as the deposit. And so we'd pay them back that equity before we go and split any profits that we make whenever we get out of the property, or whenever one of us chooses to get out. We have the option of refinancing the other person out first, and then if we couldn't refinance, we'd have to sell. So the bank of mum and dad is a great way if they're in a position to help and they want to really help you get in. The reason that you'd look to get a guarantor or look to get a gift as a deposit is that if you can get your deposit to being at least 20% of the purchase price, and I'd also expect that the purchase costs are going to be around 5%. So I'd allow 5% in every case for purchase costs. And if you can get a 20% deposit, then you don't have to pay what we call lender's mortgage insurance. So lender's mortgage insurance is not insurance for you, it's insurance for the bank to protect them against the extra risk of lending to you above 80%. So a lot of first-time investors borrow at 90%, which is still, reasonable, but you do have a lender's mortgage insurance to pay on that. Now, the other way that people sort of get into buying at a higher percentages than this, and it's pretty hard as an investor to borrow at above 90%, is that a first home buyer, there are those specialty products that are available at Keystart and potentially some other banks where they offer loans at higher loan to value ratios. And there's also home buyers deposit guarantee places that the government does have available. I'm not sure how many places of those are left, but that was also, instead of your parents guarantoring the property, the government guarantored it. And so basically you could borrow at your 90% or 95% and not have to pay lender's mortgage insurance. And that's the benefit of having the guarantor on there. So that was really helping a lot of home buyers get into a property sooner. So in that case, you would probably have to live in the property for at least 6 months, get a friend in there to help with the bills. And then you could rent it out after that, move back in with your parents, if you will, or back into living with other friends. But it might just help you get your start, because finding that initial deposit can be one of the hardest things. Then when you got your first property, you're in the market, hopefully you're getting growth, getting a good return on that deposit and that money that's been put in. Let's say your parents did put some money in, you could refinance the property later and pay them back. And then you've still got the property that's held in your name and you get the upside from there. So next step in our guide is getting help from a buyer's agent. Now, when you're starting out, I fully get that money is tight. The thought of coming up with 12 to 14 grand or whatever your buyer's agent's going to cost, some buyer's agents are even more than that. You ask yourself, how would you possibly come up with this money? Because you can't finance it usually. If you have equity set up that you can draw on, you could finance it that way. But when you're a first-time investor, you don't have any equity. You're going to have to pay for it out of cash. So it is really seem like a big other expense and an obstacle when you're starting out. But it's also because you don't know what value they can add and how much value they can add over and above their cost. So you'd never use a buyer's agent if they weren't returning to you in value far more than what they were costing. And I like to ask myself the question, can you afford not to use one? So especially when you're starting out and you know so little, it's easier to make those costly mistakes just because of the things that you don't know. So a buyer's agent can really prevent that. And a buyer's agent can add value to even an experienced investor. A good one can. And there's different episodes I've recorded on all the ways that they can add value, what they do. So check out those. And I won't go too much into it here, but just worth considering if you are on a higher income, you do have a bit more savings behind you. You'd be approaching it as an investment to use one so that they not only get you a good deal, they prevent you from overpaying, they prevent you from making mistakes. They get you to, with all of their extra research, to buy in areas that are most likely to outperform. And then that's going to well and truly pay for themselves. So next point in our property investment guide is researching property markets. So before you go out and buy something, it's best to do a bit of research, build your knowledge. And I like to start with a top-down approach. So it certainly helps to look at the economic indicators for a capital city, as well as the fundamentals that apply to that capital city and the overall Australian landscape. So lending and financing conditions apply and affect all markets everywhere. And then we've got more of those local, state and capital city based fundamentals that you can look into. to see which direction a capital city is heading. So I'm not going to spend an hour running through all of this. You can check out my Perth property market update. Last one was episode 201, where I run through, where are we at with the indicators for the sale market, for the rental market, the trends that are happening in each of those. That when we start seeing them at the Perth level, we can see when things are starting to change. And then all the suburbs have their own indicators, their own trends going on. So then once you're sort of happy and you know which way the capital city market's headed, and Perth has still got good run ahead, we would all expect. And it's going to obviously be different for different suburbs. So you really then need to do research into the growth potential for different suburbs and where is each of them at in their cycles. So the same sort of fundamentals apply. We want to look at the days on market and the trend in that. We want to look at the stock on market and is that trending down? We want to look at the online search interest and is that trending up? We want to make sure that the vacancy rate, which is how many rental properties are vacant in the area, is trending low or stable so that you're not going to have problems renting the property. And then there's more advanced things that you can look into, like the affordability index, which is a good measure to see how affordable properties still are in the area relative to other areas that you could buy at. So the more affordable an area, the more potential there is for people to pay higher rents, higher prices for houses. You can look at the building approvals and how many there are, and this is going to become more important as the building bottleneck starts to eventually fix itself. The next problem we'll start seeing is more and more building approvals in certain suburbs that are going to affect the overall supply and take the interest away from established properties in those areas. And then finally, I also like to look at large infrastructure and those kind of projects that are going to influence an overall area and add to the demand over time. So it's more just a layering effect that if all those other indicators are looking good, and then we put large infrastructure occurring to different areas. I mean, if the top level economic indicators and fundamentals are looking good for the city, then you're lining things up and they're going to have a really good best chance that the suburb's going to do well. More advanced things that we look at is what's been the relative growth of the property since this cycle started. So some areas are better value than others. And we compare that to the long-term history of growth to sort of see, well, how far has it exceeded its long-term history? That's a bit of a sign of relative value. And there's some really good data providers available to look at these things. So you can check out CoreLogic, you can check out Suburbs Finder, you can check out HTAG, which stands for higher than average growth. You can check out DSR data. So having the data is one thing, knowing what you're looking at and being able to sift through it and interpret it is another thing. And you really do, I guess it's taken me a good part of a decade minimum to develop an overall methodology and how to simplify the complexity so that, we can show clients very easily what stacks up and what doesn't and why we're investing there. So next step is looking and understanding the different investment property types and some of the pros and cons to each. So we've got here in Perth, we've got houses which are traditionally on a block of land, which are a green title block. So that means that it's got its own sewer and services connections to that block. It's not shared with any other block. And then we've got strata title, whereby apartments, villas, townhouses are all on a strata title where they have shared services and connections. They might have a shared driveway, they might have common area, and things like the overall roof would basically have a shared ownership within the group if it's over the top of a number of the units or the apartments for an entrance, for example. It's different types of strata. There's built strata where things can be overlapping and on top of each other, and there's survey strata where the strata is done to the boundary and everything within the boundary, it belongs to that lot, whereas built strata can have more common properties and more overlapping areas, and it's a bit more restrictive. So there's these different types of properties. It's worth understanding that in general, houses perform better over the longer term than villas and townhouses and then apartments, sort of being in that sort of order of relative growth. But of course, you have to factor in the location and how premium and desirable that location is, because just because you're buying a house that might be, 50, 100 kilometers from Perth in a regional town doesn't make it a good investment necessarily just because of the property type. So you still want it to be desirable. You still want to see and look at its historical growth rate to understand if it's performed well in the past. And, the benefit of buying a house is you don't have to worry about a strata group and the politics that happen. And, if you want something done to your house, you don't have to ask anyone. You can just do it. It's a lot easier to do renovations, etc., and control and influence the value of that house. But everyone has to start somewhere. So if you can't afford and get into a house, a villa would be my next choice. And then still can't get into villa, get into an apartment. And remember that there's different levels of density to all these things. So try to get into as low a density as possible with as fewer other residents, I guess, as part of that group. And that's going to keep the politics down and keep the headaches down. So hopefully that makes a bit of sense. When it comes to other investment property types like commercial properties, I'd really leave commercial to much later in your journey when the financing options for them, you have to tip in a lot more cash, typically a 70% loan. It's the maximum that you can borrow. There's a lot more risk involved with vacancy, and the tenant leaves. You may not find a new tenant very soon. And they're a bit more of a cash flow focused asset. So often not as growth focused, but they can still form and grow well, but usually not something that you'd look at as a first time investor. Now, let's take a look at choosing the right property for your overall strategy and budget. I'd start, we've spoken about taking a top-down approach. So initially, we've looked at the city, what's going on there, the economy, the fundamentals. We've then sort of looked at our different suburbs, where we might be able to afford our property type. We've looked at the indicators for the suburbs. You can get into also looking at some advanced suburb prediction tools to see, predicted growth levels. And you can look at, ultimately, we're looking at what's the demand situation on the in the suburb and what's the supply situation of properties for sale and, any building approvals that are occurring. So then we go deeper. We now start looking at the area surrounding a property. So if you're buying a family home, school catchments are very important, and to see what the quality of the schools is. When you're spending a lower amount, you generally expect a below average school in any case, but you really want to make sure that if there's a few different schools in the area that you're not buying into the worst school catchment, because that is going to impact desirability of families to purchase in that area. You then want to check some other things like flight paths, and certain suburbs, the whole suburb's in a flight path. So it's not a big deal if the whole suburb's in a flight path, but there'll be certain areas within the suburb that might be much higher trafficked by the planes. So there's parts of Kewdale, parts of Midland, parts of Guildford that are worse than others where the planes come in and go out. I'd also make sure that your property's not in a flood-prone area. There's the maps for the flood-prone maps. If you type into Google, you check that it's not in a bushfire-prone area because it would cost a lot more to rebuild. You may not be able to get insurance. And I'd also check that there's no state housing directly around your property. You may not be able to do that. I don't actually know a publicly available source of information for that. You probably have to speak to a real estate agent and get some input from there. But what you're really looking for here is what is the neighbours like and what's the quality of the surrounding area. And, I used to knock on neighbours' doors, have a chat with a few of them that are home, find out what the area's like. Is there any problems? And, a nosy neighbour will be able to tell you all about what it's like living there. So when you're looking at the specific property as well, we've looked at the area, we've made sure that stacks up. We're now looking at the actual property. So we want to see what its historical growth rate has been. You can go back and find the oldest known sale price. You can take your appraisal price, and then you can use what we call a compound interest calculator to work out what the average annual growth rate has been. And we like to compare that to what the suburb has done over the same time to see if the property itself has outperformed or if it's been an underperformer. That might have just gone over your head, but what you're really looking to do is see how has this property grown in the past. If it's done jack all, then it's probably not going to be the best performer into the future either. Now, many apartments and other things haven't done that great over the last 10 years. They're playing catch up. And so you've got to sort of compare apples with apples and look at relative performance. Now, the other thing we need to look through too is what's its rental price likely to be? You can jump on realestate.com, go to the for rent section, find some comparable properties to it. You want to appraise the property as well and find out what price you think it currently is worth. This is pretty hard, especially in an upward market. We would appraise a property not only by its most recent sales in the last 3 months, but we would try to find out what properties are under offer for. We know what we've recently bought properties in the area for, what we've missed out on in the area, wherever we've occasionally been beaten for something that went over what we wanted to pay. And so all of that adds up to informing you on price. And keep in mind that with the 6 to 8 week settlement period, by the time that something settles and the record is available and publicly seen on CoreLogic website or Price Finder, etc., that the market's usually further ahead than that. So you've got to try to get as current and up to date information so that you can make decisions on the price and be willing to pay what you need to. I'd suggest trying to pay a fair price to secure a good property rather than paying a low price to secure an inferior property that no one else is interested in. And keep in mind that if you can get access to properties off market, and this is a big part of what we do as well as buyers agents, about 20% of what we buy is off market where it's not yet on the market. That's going to, reduce your competition for the property and mean that you might not have to pay as much of a premium than if you were competing with others. But I wouldn't just focus purely on off market. It's very hard to find off markets these days, and because many sellers do want to just take their property to the market. So always better to pay a fair price for a good property than think you got the deal of the century, but it's because no one else wanted it. They didn't get any other offers and there was no other interest in the property. And if there's no interest now in what is a hot market, imagine how much interest there'll be in a cold market. There'll be zero. If you ever went to rent or sell, it could be very hard. So you also want to look through the rentability for the property, how suitable it is for having as tenants. You want it to be low maintenance. You want air conditioning as a minimum because, have you ever tried living through our hot summer without an aircon? You won't keep a good tenant that way. And that's a mandatory thing that we have for all of our rentals that we look after here at Investors Edge. And you want to, if it's got gardens and lawn, you really want to set up the tenant for success so that it can be looked after on autopilot, and if it doesn't have a retic plan, to install it, just so you're foolproofing and keeping things set up to be low maintenance. So look at that rental price that you're likely to get. Look at your expenses that you're likely to have on the property. You should be able to find out the council rates, water rates. You should know your loan amount. You should know your insurance, and you should know your property management costs, and see what your shortfall is going to be. Make sure that's affordable to you. Better to work that out before you buy it. And now, the next step of our property investment guide, you don't have to do all of this yourself. As a bit of a badge of honor, trying to do everything myself, and thought that I was saving so much money and doing this and doing that, but you don't realize what you're costing yourself. So it's really important to have the right network around you of experienced professionals. Real estate agents are going to help you get access to properties, source properties, give you input on areas, what's happening. They've got the ear to the ground. A buyer's agent, if you can afford one, or can you afford not to have one, as we discussed earlier. A great property manager. Now, the difference between what a property manager's cost might only be sort of 20, maximum of 30% difference, but a premium manager that costs a little bit extra is going to be able to save you so much extra money and headaches and be well worth the returns. So don't go scrimping on your property manager, and they can teach you so much about investing as well, and really take a lot of that hassle out of managing your property with looking after the maintenance, finding that quality tenant that's going to look after your property, inspecting it to make sure that there's nothing that is happening to degrade your property, or no leaks and whatever else when you go there. Basically making sure the overall standard to your property is maintained, so that if you ever do turn around and want to sell it or re-rent it out again, that you can do that well because the property's presented well. A finance broker, going back to one of our starting tips of working out your budget and your finance situation, is essential. And an accountant is worth running things past, but initially you're probably just going to be purchasing in personal names. But if you've got greater aspirations and you might have, if you're, for instance, a business owner, young business owner, it might be worth speaking to your accountant and making sure that you've got things structured right as well. So I find that if you can find one really great professional, that they usually have built their network out with other great professionals. So, for instance, get in touch with us. We can help you on, many of these things and connect you with the people that we trust around us as well. So I have recorded some episodes with interview questions to some of these various professionals. So we've got our property manager interview questions, buyer's agent interview questions, and I think I even did the accountant interview questions. If you go back and search on the podcast, and you should be able to find them. So next is understanding some of the risks and preparing for the unexpected. And I didn't want to leave off this episode without tackling some of these things that aren't as sexy, but I want you to be prepared for the worst. So vacancies can happen. So it's worth having a bit of a rainy day fund. I'd recommend having probably at least a month's rent aside, and I'd probably set up and have at least a 5K cash buffer for the larger maintenance cost type things that can happen, such as a hot water system or an aircon. 5K is going to cover those, usually with change, and just make sure that you're not caught out. And be prepared for market fluctuations. If you are able to hold the property indefinitely, you're not going to care as much about whether the market goes up for the next 2 to 3 years and then takes a pause, comes off a little bit, and then continues around in its cycle. But be prepared for those market fluctuations. The rents, once they hit their peak at some point, might soften a bit and start coming off a bit. So don't count on getting that maximum rent forever. Have a bit of, the more buffer you can sort of put aside, the better you are with your savings, that you're going to be able to do that. And, how you mitigate the chances of having your property damaged or having it, degraded over time really comes down to choosing a quality tenant. Like, that is the key to setting everything else up to be stress-free. So make sure your property manager is really going to focus on that. And that's something that we really pride ourselves in with our extremely thorough screening that we do of tenants, and we've got our quality tenant guarantee. So, and I just look at maintaining a risk management mindset and sort of look at the potential risks. That's why we have insurance and other things to cover ourselves. You look at setting the property up to be safe and maintenance, low maintenance. You look at having the right team around you to reduce your risks and spot anything that could hurt you as well. So all of that should add up to making it a very safe investment for you that's far less risk than if you just tried to go and do it all yourself. Now, finally, we've covered a lot today. I don't want this to overwhelm you. I don't want this to hurt your head and make you think that it's all so hard. Just take it a step at a time, find the right professionals that can guide you, and look to take action. Don't always wait around for that perfect property. We come across clients that have been looking for a property for 1 year, 2 years. At some point, it gets all too hard and they give up. So they would have been far better off just buying a property that met and passed the major things, that was still desirable and didn't have any major negatives to it, than waiting for that perfect one to come around. They would have been in the market, getting their gains, and then having those choices for what else they can do moving forward. Now, finally, what are some common mistakes and how to avoid them? So for first-time investors, I often see them over-leveraging. And just because you can borrow something doesn't mean that you should. I'd really look through to what's affordable there. The other one I see is emotional buying. So they miss out on one or two properties. They could be missing out, could have missed out on 4 or 5 or even more. And they're often missing out because they don't have those negotiation skills. They don't know how to, relate to agents. They don't know how to price a property, find out what price to pay. And then they end up just way over the top emotional buying. And that can be really detrimental if you overpay for a property. It can take ages for the market to catch up. And then the next one that I typically see is a lack of research. So, they rush in, they buy a property, they then start to ask questions later. They haven't really looked at choosing the suburb properly to have the best chance of growth, especially in the short term, which you should be able to work out, even just with basic trend analysis, which direction a suburb's heading. And this is going to be really important as our market starts to change and suburbs become overpriced and start to stagnate, and eventually start to, slowly start to drift back. So a lack of research, and it can be daunting to know where to get started. Hopefully from today's episode, that's really going to help. The key to solving that one is to try to get enough savings to afford your buyer's agent. And if you tap into the bank of mum and dad as an overall risk mitigation and to ensure the best possible investment, I'd be encouraging them to contribute or trying to get their help with affording a buyer's agent as well, because it's going to pay you all back and really make sure that their investment in you is taking the risk out of it all. So we've covered a lot today. Really encourage you to get into the market if you are sitting on the sideline and you've just seen things pass you by over the last sort of year or two. There is still more upside ahead. I'd start out with getting that clearer plan of why you're investing, defining your goals. Is it too soon for a strategic portfolio plan? Look, if you want to do things right from the start, it could be worth getting one with us. There is a cost attached to that as well, but it could be well worth the expense. I'd look at it as more of a return on that investment. You then look at understanding your budget and financing options and, trying to get that first deposit together, trying to make sure it's affordable. You look at getting help from a buyer's agent, and then you go into researching your property market, starting from the top down, starting with the city and state and economics and the fundamentals to that, then going down to the suburb level, then the area, and then the property. And we've spoken about choosing the right sort of property to fit your strategy, building up that support network to help you every step of the way, mitigating your risks and avoiding those most common mistakes. So hopefully you're all set to go with this guide to property investment helping. And do feel free to reach out if there's any gaps or if you want our help with any of our services. And if you have enjoyed today's episode, share it with someone that you know that might be starting out or on their journey and want to fill in some gaps. And if you've enjoyed it, love for you to write a review or share it with your friends. So thank you so much for tuning in, and I'll catch you on the next one. Bye.
Just a reminder, the information discussed in this podcast is general in nature. As we don't know your specific situation, you should always seek professional advice before taking any action. For free market reports on your suburbs of interest and other helpful resources to grow your wealth, make sure you join my property investor update at investorsedge.com.au/join. And finally, make sure you're a member of our Perth Property Investment Facebook group to be part of the conversation with other like-minded investors, get help to your questions, and get a feel for what's going on out there in the market. I'll see you in the group.